what I'd buy today with only $5,000. They say the hardest dollar to invest is the first one. I disagree. The hardest dollar to invest is the one you have right now. When you know the system is rigged against small capital, when liquidity is thin, when every basis point of friction eats into your edge, and when the emotional investor around you is making the same predictable mistakes they've always made. If you're sitting on $5,000 today, wondering where to deploy it, you're not asking the wrong question. You're asking it at exactly the right time. Because $5,000, handled with discipline and mathematical precision, can be the seed of a system that survives every downturn and compounds relentlessly over decades. But only if you understand the rules. The real rules, not the ones they sell you on financial television. Before we go further, if you're the kind of person who wants to think like a quantitative investor, who wants to strip away the noise and focus on probability, optionality, and survival, then subscribe now. This channel exists to give you the cold, logical frameworks that others ignore. Don't wait. Do it now. Let me be direct. $5,000 is not a large sum in absolute terms. It will not buy you a diversified portfolio of individual stocks with meaningful positions. It will not give you access to hedge funds or private equity. It will not allow you to trade futures with sufficient margin to withstand volatility. And it will not make you rich overnight. Anyone who tells you otherwise is either lying or delusional. But what $5,000 can do, if deployed correctly, is establish the foundation of a system that prioritizes survival, minimizes friction, maximizes optionality, and compounds over time. That is the only rational objective for small capital. Not to swing for the fences, but to build a structure that allows you to stay in the game long enough to benefit from the inevitable cycles of market irrationality. The first principle you must internalize is this: small capital has different constraints than large capital. When you manage billions, your constraint is liquidity. You cannot move quickly without moving the market against yourself. You must think in terms of beta exposure, factor tilts, and portfolio construction across hundreds of positions. But when you manage $5,000, your constraint is not liquidity. Your constraint is friction. Every trade costs you money in commissions, spreads, and slippage. Every dollar you allocate to the wrong vehicle costs you in fees, tracking error, or opportunity cost. The emotional investor with $5,000 makes one of two mistakes. Either they over-diversify, spreading their capital so thin across dozens of positions that no single position matters, and they pay friction on every one. Or they over-concentrate, betting everything on a single stock or cryptocurrency, turning their portfolio into a binary gamble. Both approaches are mathematically flawed. The quantitative approach is different. You accept that with $5,000, you cannot replicate the portfolio of a large institution. You accept that you will have fewer positions and that each position will carry more weight. But you also accept that the goal is not to maximize short-term returns. The goal is to maximize the probability of long-term survival and compounding. That means minimizing unnecessary friction, maintaining optionality, and positioning yourself to exploit the market's inevitable overreactions without exposing yourself to catastrophic loss. Let me walk you through the framework. The structure I would use with $5,000 today consists of 3 layers, each serving a distinct purpose in the system. Layer 1 is the core. This is the non-negotiable foundation, the ballast that ensures the system survives when everything else is volatile. Layer 2 is the tactical allocation, the part of the portfolio that responds to current market conditions and takes advantage of mispricings or dislocations. Layer 3 is the optionality reserve, the portion held in cash or near cash instruments that allows you to act when the market presents asymmetric opportunities. These 3 layers are not arbitrary. They are the mathematical expression of a system designed for resilience, adaptability, and long-term compounding. Layer 1, the core, should represent approximately 60% of your capital. In this case, $3,000. The purpose of the core is not to generate outsized returns. It is to provide stability, diversification, and exposure to the broad market with minimal friction. The emotional investor sees this as boring. The quant sees it as essential. Without a stable core, your system has no anchor. It becomes entirely dependent on the success of individual bets. And individual bets, no matter how well researched, carry tail risk. The most efficient way to build this core with $5,000 is through low-cost, broad market index funds or exchange-traded funds. Specifically, I would allocate this $3,000 to a single globally diversified equity ETF with the lowest possible expense ratio, something that tracks a total world stock index or a combination of U.S. and international equities with automatic rebalancing. Why equity? Because over the long term, equities have consistently provided the highest real returns of any major asset class. This is not speculation. It is a statistical fact supported by over a century of data. Equities represent ownership in productive enterprises, and productive enterprises, in aggregate, generate profits that grow over time. When you own a broad index of equities, you are not betting on any single company or sector. You are betting on the long-term productivity of the global economy. That is a bet with favorable odds. Why a single fund? Because with small capital, diversification across multiple funds introduces unnecessary complexity and friction. Each fund has a bid-ask spread, each trade has a cost, and each additional position requires monitoring and rebalancing. A single, globally diversified fund gives you exposure to thousands of companies across dozens of countries and sectors. You achieve diversification without the friction. This is the principle of parsimony. The simplest system that achieves the objective is the best system. Why low cost? Because fees are a direct drag on returns, and they compound against you over time. An expense ratio of 0.03% versus 0.5% may seem trivial in a single year, but over 20 or 30 years, the difference is enormous. Every basis point you save in fees is a basis point that compounds in your favor. The emotional investor ignores fees because they are not visible in daily price movements. The quant obsesses over fees because they are a mathematical certainty. You cannot control the market, but you can control your costs. This core holding serves another critical function. It is the psychological anchor that prevents you from making emotional decisions during market downturns. When the market drops 20 or 30%, and it will, your core holding will drop as well. But because it is diversified across the entire market, it will not go to zero. It will recover, as it always has, given sufficient time. That recovery is not guaranteed by any law of nature, but it is the most probable outcome based on the historical behavior of capitalist economies. More importantly, the existence of a stable core allows you to view market downturns not as disasters, but as opportunities to deploy your optionality reserve. Without the core, every downturn feels like an existential threat. With the core, every downturn is a potential buying opportunity. Layer 2, the tactical allocation, represents approximately 30% of your capital. In this case, $1,500. The purpose of the tactical allocation is to take advantage of current market conditions, mispricings, or dislocations that offer asymmetric risk-reward profiles. This is where you can express a view, not based on emotion or prediction, but based on statistical analysis, valuation metrics, or structural inefficiencies. The key distinction is that the tactical allocation is not permanent. It is designed to be adjusted as conditions change. It is not a buy and hold position. It is a position taken with a specific thesis, a specific time horizon, and a specific exit condition. With $1,500, you cannot afford to spread this across dozens of positions. You need concentration, but disciplined concentration. I would allocate this to no more than 2 or 3 positions, each chosen based on a clear, quantifiable thesis. Let me give you examples of the kind of tactical allocations I would consider today, not as recommendations, but as illustrations of the thinking process. Example one, sector rotation based on interest rate cycles. If the Federal Reserve is in a tightening cycle, raising interest rates to combat inflation, certain sectors systematically underperform and others outperform. Financials, particularly banks, tend to benefit from rising rates because their net interest margins expand. Technology stocks, particularly high-growth, unprofitable companies, tend to suffer because their valuations are based on distant cash flows that are discounted at higher rates. A tactical allocation in this environment might involve a position in a financial sector ETF, not because you love banks, but because the mathematical relationship between interest rates and bank profitability is well established. You hold this position as long as the Fed is tightening, and you exit when the cycle reverses. This is not market timing. It is cycle awareness. Example two, volatility arbitrage through options. When market volatility is historically low, implied volatility on options is often cheap relative to realized volatility. This creates an opportunity to buy protection or to structure trades that benefit from a spike in volatility. With $1,500, you cannot trade complex option strategies with multiple legs, but you can buy out-of-the-money put options on a broad index as a hedge against a market downturn. The cost is small, the potential payoff is large, and the asymmetry is favorable. This is not gambling. It is paying a known premium for a non-linear payoff. The emotional investor sees options as risky. The quant sees options as tools for managing tail risk and creating asymmetry. Example three, mean reversion in oversold assets. Markets overreact. This is not a theory. It is a statistical regularity. When an asset or sector experiences a sharp, sudden decline that is not accompanied by a corresponding change in fundamentals, the probability of a mean reversion increases. A tactical allocation here might involve identifying a sector or commodity that has dropped 20 or 30% in a short period, analyzing whether the decline is driven by temporary factors or permanent impairment, and taking a position size to reflect the uncertainty. You are not predicting the bottom. You are positioning for a probabilistic rebound, and you size the position so that if you are wrong, the loss is tolerable. The critical discipline in the tactical allocation is this: every position must have a thesis, a time horizon, and an exit condition. You do not buy and hope. You buy based on a quantifiable edge. You hold as long as the edge persists, and you exit when the edge disappears or when the position reaches a predefined loss threshold. This is the essence of systematic investing. It removes emotion from the equation and replaces it with rules. Layer three, the optionality reserve represents approximately 10% of your capital, in this case, $500. The emotional investor sees $500 in cash and thinks it is wasted capital, earning nothing, sitting idle. The quant sees $500 in cash and thinks it is the most powerful asset in the portfolio. Why? Because cash is pure optionality. It is the ability to act when others cannot. It is the ammunition you deploy when the market is in free fall and assets are being sold at fire sale prices. It is the buffer that allows you to avoid forced liquidation when volatility spikes. It is the mathematical certainty that you can wait for the probability distribution to normalize without being forced to sell at the worst possible moment. The value of cash is not its yield. The value of cash is its flexibility. When the market drops 30 or 40%, and it will, the investor who is 100% invested has no recourse. They can either sell into the panic, locking in losses, or they can hold and hope for recovery. Both are passive responses. The investor who holds 10 or 20% cash has a third option: buy. They can deploy capital when assets are cheap, when fear is at its peak, and when the expected value of future returns is highest. That optionality is worth far more than the opportunity cost of holding cash. With $500, you are not going to transform your portfolio overnight when a crash occurs. but you will be able to add a meaningful increment to your core holding or your tactical allocation at depressed prices. And more importantly, you will have trained your mind to see market crashes not as disasters, but as opportunities. That psychological shift is the difference between the amateur who panics and the professional who profits. Here is the critical point that most people miss. The structure I have described, 60% core, 30% tactical, 10% cash, is not static. It is dynamic. As market conditions change, as volatility rises or falls, as valuations expand or contract, the allocations shift. When the market is expensive and volatility is low, you increase your cash reserve and reduce your tactical exposure. When the market is cheap and volatility is high, you deploy your cash and increase your equity exposure. The system is constantly rebalancing itself based on quantifiable signals, not on emotion or gut feeling. Let me address a question that is likely forming in your mind. What about individual stocks? What about picking winners, finding the next Amazon or Tesla, and concentrating capital there? The answer is simple. With $5,000, individual stock picking is a negative expected value activity. Why? Because individual stocks carry idiosyncratic risk, the risk that a single company fails. And with small capital, you cannot diversify away that risk without spreading your positions so thin that transaction costs dominate. Moreover, stock picking requires time, expertise, and access to information that the average investor does not have. If you are competing against institutional investors with teams of analysts, proprietary data, and algorithmic trading systems, you are playing a game where the odds are stacked against you. The quant does not play games where the odds are unfavorable. The quant finds games where the edge is clear and the odds are in their favor. But there is another dimension to consider here, one that goes beyond asset allocation. It is the dimension of behavior. The structure I have outlined, the core, the tactical allocation, the optionality reserve, is designed not only to maximize expected returns, but also to minimize the probability of catastrophic mistakes. Most investors with small capital lose money not because they picked the wrong assets, but because they made the wrong decisions at the wrong times. They bought at the top out of greed, they sold at the bottom out of fear, and they churned their portfolio out of impatience. These are behavioral failures, not analytical failures. The system I have described is engineered to prevent those failures. The core holding is boring. It does not produce dopamine hits from daily price swings. That is the point. It anchors your behavior and prevents you from making impulsive decisions. The tactical allocation gives you a controlled outlet for your desire to take action, to express a view, but it does so within a framework of rules that prevent overconcentration and overleveraging. The cash reserve gives you the psychological comfort of knowing that you are not trapped, that you have options, and that you can act if an opportunity arises. This is not just portfolio construction. It is behavioral engineering. Now let me address the role of alternative assets, cryptocurrencies, commodities, real estate, private equity. With $5,000, most of these are either inaccessible or suboptimal. Cryptocurrencies are highly volatile, largely speculative, and offer no cash flows or intrinsic value to anchor their price. They may have a place in a portfolio as a small speculative position, but they should not be a core holding. Commodities are difficult to hold directly without incurring storage costs or contango in futures markets. Commodity ETFs exist, but they often have poor tracking and high fees. Real estate requires far more capital than $5,000, and REITs, while accessible, are essentially a subset of equities. Private equity is entirely inaccessible at this capital level. The lesson here is simple. Do not chase exotic assets because they sound interesting. Focus on what is efficient, liquid, and low cost. That is where small capital has the best odds. Let me also address leverage. Should you use margin or leverage to amplify your returns with $5,000? The answer is an emphatic no. Leverage is a tool for institutional investors with sophisticated risk management systems, deep liquidity reserves, and the ability to withstand margin calls. For an individual with $5,000, leverage is a catastrophic risk. It turns a manageable drawdown into a forced liquidation. It transforms a temporary market correction into a permanent loss of capital. The emotional investor sees leverage as a way to accelerate gains. The quant sees leverage as a way to accelerate ruin. Do not use it. Here is the deeper principle at work. The system I am describing is not optimized for maximum short-term returns. It is optimized for maximum long-term survival and compounding. Those are two different objectives, and they require two different approaches. Maximizing short-term returns requires taking concentrated bets, using leverage, chasing momentum, and accepting the risk of total loss. Maximizing long-term survival requires diversification, liquidity, discipline, and the willingness to accept lower returns in exchange for lower risk of ruin. The emotional investor optimizes for excitement. The quant optimizes for survival. And survival, over a long enough time horizon, guarantees that you will outperform the vast majority of participants who did not survive. Let me give you a historical example. During the dot-com bubble of the late 1990s, investors with small capital saw technology stocks doubling and tripling in a matter of months. The temptation was overwhelming. Many concentrated their entire portfolios in tech stocks, believing that the trend would continue indefinitely. When the bubble burst in 2000, those portfolios collapsed. Many investors lost 70, 80, even 90% of their capital. They never recovered, not because they lacked intelligence, but because they violated the principle of survival. They optimized for short-term gains and paid the price with long-term ruin. Meanwhile, the investors who held diversified portfolios, who maintained cash reserves, and who did not chase the bubble, survived. They suffered losses, but they survived. And because they survived, they were able to deploy capital during the recovery and benefit from the next cycle. That is the power of a system designed for survival. Another historical example, during the 2008 financial crisis, credit markets froze, liquidity evaporated, and asset prices plummeted. Investors who were fully invested and leveraged were forced to sell at the worst possible prices. They had no optionality, no reserves, no ability to wait. But investors who had maintained cash reserves, who had avoided excessive leverage, and who had structured their portfolios for resilience were able to buy assets at generational lows. They purchased equities at valuations not seen in decades, and they reaped enormous returns over the following 10 years. The difference was not intelligence or foresight. It was structure. It was having a system that allowed them to act when others could not. This brings me to the most important point. With $5,000, your objective is not to get rich quickly. Your objective is to not get poor. That may sound passive, but it is the most active strategy there is, because in markets, the majority of participants lose money over time. They lose it to fees, to poor timing, to emotional decisions, to overconcentration, to leverage, to chasing trends. If you can simply avoid those mistakes, if you can build a system that survives and compounds at a modest rate, you will outperform the majority. And over decades, that modest compounding becomes extraordinary. This is the mathematical reality that most people refuse to accept because it is not exciting, but it is true. Let me walk you through a specific scenario to make this concrete. Suppose you start with $5,000 today and allocate it as I have described. $3,000 in a global equity ETF, $1,500 in 2 tactical positions, and $500 in cash. Suppose the equity market returns 7% annually, which is below the historical average. After 10 years, your $3,000 in the core becomes approximately $6,000. Suppose your tactical allocations, on average, break even after accounting for some wins and some losses. And suppose you deploy your cash reserve twice during that decade, during market downturns, and capture an additional $1,000 in gains. Your total portfolio after 10 years is approximately $7,000. That is not a life-changing sum, but it is a 40% gain after inflation, and it is the result of discipline, not luck. But here is where the compounding becomes powerful. Suppose you continue to contribute $500 per year to this system. Not a large amount, roughly $40 per month. After 20 years, assuming the same modest returns, your portfolio is now worth over $30,000. After 30 years, it is worth over $80,000. And after 40 years, it is worth over $200,000. This is not speculation, this is arithmetic. This is the result of starting with a small sum, adding modest contributions, avoiding catastrophic mistakes, and letting time do the work. The emotional investor looks at $5,000 and thinks it is too small to matter. The quant looks at $5,000 and sees the seed of a system that, given enough time, becomes substantial. But time is the critical variable. The younger you are, the more powerful the system becomes. If you are 25 years old with $5,000, you have 40 years of compounding ahead of you. If you are 55 years old with $5,000, you have 10 years. The math is different. The strategy must adapt. For younger investors, the emphasis should be on equity exposure and aggressive saving. For older investors, the emphasis should shift toward capital preservation and income generation. But the underlying principles remain the same: minimize friction, maintain optionality, avoid catastrophic risk, and let the system run. Now let me address a question that is implicit in all of this. What if you do not have the discipline to follow this system? What if the temptation to chase the next hot stock, the next cryptocurrency, the next momentum trade is too strong? The answer is that you must engineer your environment to make discipline easy and impulsivity difficult. This is not a moral issue, it is a structural issue. If you leave your portfolio on a platform that allows you to trade with a single click, you will trade too often. If you check your portfolio every day, you will react to daily noise. If you watch financial television, you will be bombarded with emotional narratives designed to make you trade. The solution is to remove those triggers. Automate your contributions, automate your rebalancing, and limit your ability to make impulsive changes. The best portfolio is the one you can ignore for long periods of time because it is structured to survive without constant intervention. There is a deeper truth here that most people miss. Investing is not about being smart. It is about not being stupid. The vast majority of investment returns come not from brilliant insights, but from avoiding dumb mistakes. Not overtrading, not over-leveraging, not panicking during downturns, not chasing bubbles, not paying excessive fees. These are not advanced concepts. They are basic principles. But they are systematically violated by the majority of investors because those investors are driven by emotion, not by logic. If you can simply adhere to a system that prevents those violations, you will outperform. That is the edge. It is not a complicated algorithm or a secret formula. It is discipline. Let me be clear about one more thing. This is not advice tailored to your specific situation. This is a framework, a way of thinking about small capital and how to structure it for long-term success. Your individual circumstances may differ. You may have higher risk tolerance or lower. You may have access to certain investments that others do not. You may have specific financial goals that require a different allocation. The framework is flexible. What is not flexible is the underlying logic. Prioritize survival, minimize friction, maintain optionality, and let compounding do the work. Those principles are universal. I want you to leave today with this understanding. $5,000 is not an obstacle. It is an opportunity. It is the opportunity to build a system from the ground up, to establish habits that will serve you for decades, and to learn the discipline required to navigate markets without being destroyed by them. The emotional investor looks at $5,000 and sees limitation. The quant looks at $5,000 and sees the first data point in a long-term compounding function. The difference is not the capital. It is the mindset. And the mindset is something you can change today, right now, this moment. You do not need more money to start thinking like a quant. You need to start thinking like quant to grow your money. Remember, this content is educational and does not constitute financial advice. Its purpose is to help you think from a quantitative and mathematical perspective. The markets do not care about your intentions. They do not reward hope. They reward structure, discipline, and the willingness to play the long game when everyone else is chasing short-term noise. With $5,000 in the right system, you are not at a disadvantage. You are simply at the beginning. And the beginning, handled correctly, is where every compounding fortune starts.